The Fed has been very optimistic about the economy. It's doing so well when you ignore most of the indicators. Retail investors have been pouring their money into the stock market to chase the gains, which have been unprecedented. Companies have watched as central banks buy up their shares, giving confidence to the market. There's just one problem. Central banks are now in a tightening cycle. Oops. You came here for the truth, so let me unveil that for you. Today we are going to look at the indicators which show us we have reason to be concerned. I will begin with this: Fed funds rate and total debt. What you can see here clearly, over the years we have accumulated more and more debt. At the same time, we have watched interest rates declining. Okay, very important to see how these two interact with each other. The lower the interest rates are, the easier it is to borrow, and clearly the more people will borrow, the more governments will borrow, the more everybody is borrowing. You will see here, as I've shown you before, as I've harped on over the years, that the Federal Reserve is unable to bring interest rates back up to the levels they were at previously. Every single time they try to, we have a recession. You will see that the Federal Reserve had kept interest rates down to zero. Now they're notching it up. What is very concerning, as you can see from these two lines, is that we are now at the time frame where we need to be worried. Looking at this in their previous tightening cycles, you could see that they get to a point where they start to be unable to raise interest rates as the economy slows down. They go sideways. Then the recession begins. They're already too late, and then they drop them down. We are in that territory today, right now. Whether or not it's going to take 3 months, 6 months, a year, I don't really know. But according to this, which is what I believe is one of the top 3 indicators, this right here shows us we have reason to worry. Looking at it, at most, I would say at most, by the end of the year, this indicator is going to be tripping off. Looking at it really is a telltale sign of what we are going to expect. The most important thing today is interest rates, borrowing costs. How expensive is it to do financial transactions? Whether we're looking at the Fed funds rate, whether we're looking at, whether it's the Bank of Japan, ECB, all the other central banks, maybe the LIBOR rate, it's so important to understand these factors. USD prime lending rate, another interesting one. When it peaks out, it looks like we have the same thing, that it simply drops off. We still have some time to go here. Right now, we're going from, I would say, about, in the previous instance, 8. But once this gets to around 6 or so, we should be, I think, right in this region here. So the next few, maybe a year, maybe 2 years, based on this indicator, the prime lending rate. That's another one to look for. I see that the hard economic data showing us a decline. I've been covering that for a while. It's very clear. The hard data shows us that we're not doing well, but the soft data is more reasonable. Fed funds rate going up. And of course, as the rate goes up, it becomes more and more difficult to do business. Rising deficits and rising rates. We have a big problem. Again, another indicator where we saw this occur back during the financial crisis, during the dot-com boom and bust. I look at this, the deficit as a percentage of the GDP, and how the Fed funds rate affects that. We need that Fed funds rate to be 0. If it's not 0, we have a big problem. And so, how long will it take? Again, I don't really know. But we're looking at these factors as being incredibly crucial to give us that warning that we need. This right here is part of two charts. I'll just show you this quickly. Equity market cap in billions. And if you're interested, you can see that for yourself. But I really want to show you this. Equity index percentage from all-time high. Look at the red across the screen. Whether it is looking at markets in North America, Europe, Asia, we have a lot of emerging markets. They're down significantly. And you'll see that here. Look, if I take tech sector, it might be doing okay. But if I take, vast swaths of other stocks, it's not doing well. And this is a sign that despite all of the liquidity measures they've been putting into place since 2009, they have been unable to keep the markets going. All you have to do is extract FANG stocks or the FANG plus stocks from the equation, and also take away things like the fake inflation rate, the fake unemployment rate, and all of the other fake numbers they provide us, and look at the real situation. The jobs numbers, my goodness, those are terrible. And look at what's really happening. Literally, $20 trillion has been printed over the last, let's say, 20 years or so. 15 trillion, I think, just since the financial crisis. And yet the stock markets can't stay afloat. That's unbelievable. But hey, if you're invested in FANG stocks, I guess you're doing fine. Evolution of global FMS biggest tail risks right now, trade issues are the one to watch out for according to the surveys done by Bank of America, Merrill Lynch, something I cover every month here. That's an issue. It was what I think is funny because in this case, it's showing us this. Previously, it was quantitative tightening. That's not the concern anymore. Trade issues are the concern, and you can see what has happened with China and the US right now as I record this video. But I wanted to show you this as well. Most crowded trades. Long FANG plus BAT here is a big problem. That wasn't a problem before. It used to be long US dollar. All right, throughout 2015. That's what the trade was. Then it was long quality. Apparently that's bad. Long US dollar again. Briefly we had this, but anyway, long NASDAQ. But now it's just a few stocks. Not the whole NASDAQ, just a few stocks. The concentration of wealth, the concentration of all of these purchases is never, ever a good sign. Look at these here, where you can see the most creditworthy nations on the left-hand side and the least creditworthy nations on the right-hand side. And this should come as no surprise. Germany, most creditworthy. Least creditworthy is Venezuela. These are the CDS spreads. Germany at 11, and Venezuela's at 11,000. It's something to note. Now, that doesn't mean that necessarily a country like Argentina is going to necessarily do better than Venezuela just because of the CDS. But that's the way the market prices it in. And I do believe that it is important to watch the spread of the CDS because there are going to be people taking bets on that. And just like Greece, you got to watch out. This here shows us something that it's important to note. Record RSI right now, okay? Just completely blowing off the top here. And also the fact that we have seen the stock market itself it's been rising dramatically. When you look at a handful of stocks, the U.S. market, that is, we have seen the rise that has been really undeserved when we compare it to the real economy. There have been some positive changes. Don't get me wrong. I've seen some positivity come out over these past couple years. But it's not enough to warrant what we have seen with the stock market. Okay? So perhaps if the actual economy has been growing at this rate here, we are seeing the stock market rising like this. FANG stocks. And that's not really good. I would rather the stock market continues forever just to rise at this rate, even if it's just a few percent. Instead of having these wild swings up and down, nobody can pay attention. Nobody can follow along. It's crazy. I would just rather a few percent every year. You could put your money in there, put it in dividend stocks, and just let it ride. That would be good. But it's not the way it works. It's such violent swings up and down, and that's because of central banks. Before the intervention of the Federal Reserve, prior to 1913, look at the stock market swings. It's not quite as bad. Sure, we don't see the rise that we've seen in the recent bull markets. But that's okay, because you want to just put your money in there and let it collect, let it appreciate, and get the dividend income. That doesn't happen anymore. And last but not least, government-issued debt securities, and at the bottom, global equity market cap. I just wanted to note the fact that, think about this. All of these debt securities, all of these investments that people are making today, number one, quite frankly, there's just way too much debt. Number two, all of this has an interest rate that's behind it. LIBOR is in the hundreds of trillions of dollars worth based on this particular interest rate. Now, if that interest rate increases suddenly, it becomes too expensive. So they have to go somewhere else. They have to sell off, whatever it might be. Interest rates are rising. And that is, in fact, a very big concern. I think for the U.S., it's something that we should be watching out for. There's a lot of these debt instruments really in play for the U.S. They're more secure, I would say, than some of the other areas, obviously, like Argentina and Venezuela. But just know, the U.S. is the one that we need to be very worried about, because since the financial crisis, they have taken the most extreme risk. They may not get hit necessarily first. They may not be the first domino to fall, but they will be hit very, very hard. If you found this video informative, please give me a thumbs up. When you give me a thumbs up, it helps to support the channel. So I do appreciate it. And if you want the financial education that was not taught to you in schools, these two books have it all. You go through school, you don't learn a single thing about how to protect your money, how to invest, what's really going on behind the scenes. So I took the liberty of taking everything I have learned, squeezing it down into these two books. They fit into each other like puzzle pieces. So I recommend getting both, but take a look at them for yourself at Amazon. There are links in the description below. If you're not interested in reading, but you prefer the audiobook version of Global Economic Collapse, you can get that at themoneygps.com.